Good morning and welcome back to the Haven Financial Group radio show. I'm Larry Colvig, founder and CEO of the Haven Financial Group. I have Kyle Thomas, certified financial planner with the Haven investment team on today, talking about interest rates, inflation, all those topics, Kim, that are just so fun, maybe not fun, but so important to really any listener, young or older, retired or soon to be retired. So if we're speaking to you, if you're looking for more information about any of these key retirement topics, and not just this, investments, estate planning, long-term care, just this past week on estate planning, Carrie and Keith, our estate planning partners, we had 2 full classes in Shakopee, wills, trusts, and legacy planning. Another important topic, Medicare, annual enrollment, any of these things as they relate to you and your situation and your decision-making. Maybe it's time to get a partner. So feel free to give us a call at 612-504-8400 or visit us online at havenfinancialgroup.com.
We've been talking this morning about the lower interest rates. The Federal Reserve in the last week and a half lowering interest rates for the second time in 2025. And there is still some discussion and some head scratching as to whether they'll come down again. So how does this impact a pre-retiree or someone who is in retirement? We want to talk about decision making as these rates come down. So the best way to make decisions, no doubt, Larry has said this many, many times, is to be informed, to understand, to have knowledge. Kyle Thomas is with us, a certified financial planner. And Kyle, I want to ask you about, as these interest rates come down, there are some terms that they use: low, lower, and lowering interest rates. Can you explain to us what those 3 things mean?
Yeah. So low, lower, and lowering is definitely, it could be kind of confusing to just everyday life. But the way that it's described is low. That would be, if rates were lower than what they have been over time, or lower than the average in terms of history across the whole economy. And then lower, that would be if rates are lower than they were, just yesterday or last year, but not necessarily low interest rates. It just means that they're lower than, a previous benchmark maybe. And then lowering, that just kind of says that rates are in a trend of being lowered, right? So if, think about it on a steps going downwards, right? You're going downstairs. Maybe that would be like a lowering scale of interest rates. Mm-hmm. And so I think that's kind of where we're in right now. Hopefully we can get a couple more cuts in the near future here. And then, we can get into some lower rates in the future. That would be nice.
Yeah, absolutely. So we're lowering. So let's talk about what that means for people who are listening and pre-retirees and retirees. They're higher right now than they have been in the lifetime of people who are retired right now. But what's the impact?
Well, the impact is it's going to affect the bond returns. That's the biggest part of the puzzle. And we're going to have lower yields, potentially higher stock yields. But right now is a great time to be opportunistic and kind of jump on some of these higher rates, because we don't know when they would be back at this point again. This could be the highest yields that we see for the next 10 years. Maybe it's for the next 20 years. We don't know. But what we do know is that, like you said, they are higher in context of, the last decade, and we can lock in some of those higher rates, just like in annuities and CDs and treasuries. Especially people with tax considerations, treasuries are a great option in the state of Minnesota because those offer state tax-free interest. And you can get interest just as high as CDs almost. So it's just important to look at all these options to create that income for you and lock in some of those higher rates before they start to dwindle down and go into that lowering phase.
As 2 experts who have watched this game for a long time, when people are listening right now and they're hearing you say maybe you should be opportunistic, What's the timeline there? How much time do they have to take advantage or to change before being affected?
Well, I would say you'd probably want to take a look at doing this within the next, before the end of the year, I should say, actually, because, I'm thinking December is probably the next cut this year, if there is one this year. I don't think November is going to have one. But I would say before the end of the year, it's probably a good time to start looking at it. And then, you can start the new year off with a clean slate if there's any changes there. And I just, you could look at it in January too. I just kind of personally like to start a new year off with,
Right.
any new strategies and that stuff. But I would definitely say before the next rate cut would be a good time to look at this, because once those rates come down, then changes are implemented immediately with the rates.
I guess I would add, depending upon what your situation is, what is your strategy? If Kyle mentioned, if you're lending as putting money in CDs, high yield savings, interest rates have come down, but they're not nearly as low as they were for almost 15 years. In fact, we have a fixed annuity still that's relevant. There's terms to it. You should always understand. It's why I teach the class the truth about annuities. But we have a fixed index annuity. The first year, they're guaranteeing you 7.35% still. If you want more information and it sounds appealing, let's get you all the facts, because that's what's important. If you're borrowing and maybe waiting for rates to come down, maybe that's part of your strategy. Mortgage rates. Now, I've said it before. Other financial folks will differ on me, but I love to see retirees not have a mortgage. I can show you many examples of people that have it fired back. They didn't pay off the mortgage. They kept it in the market, and unfortunately, that didn't work so well. The happiest people in retirement, my observation in all the years, do not have a mortgage. That's not relative for everybody. Not everybody can get there, but I think it's a good goal for a lot of people. So again, depending upon what you're doing and what you need, your strategy will play out as far as the timeliness of doing it or not doing it. But again, there's always these shifts in there. This isn't new territory. This is not uncharted territory. It's just we as humans, we live in the present. So in the present, it all seems like, oh my goodness, this is something brand new. It's not as if we haven't seen this before, but we just have to navigate accordingly. Do you have a partner that you can call, or are you doing this alone? Maybe that's not the answer that you should have.
It seems to be too in this climate that people are going to need to be flexible, because, you might make those changes as Kyle had recommended before the end of the year. And then we might hit January or February and we're going to see them go down again. And that might mean another change. So you're going to have to be sort of flexible and be prepared to make a lot of changes possibly as this comes down.
Yeah, but that's where it's really nice to have a partner who's working with you on this, because that's something that we do every day. We're making changes for people on a daily basis, and reallocating portfolios from stuff that they had elsewhere, and that we always have a good strategy around that, and making sure that we minimize any taxes or try to do things completely tax-free as well. So having a partner can really help with that and relieve a lot of stress around that, because it is a big undertaking if you're trying to do it on your own, because there's a lot of thought that goes into it and planning that should be done. So make sure that you have someone that you can just soundboard stuff off if you're going to be trying to do it on your own. But also, I highly suggest working with a partner.
So that all circles back. Oh, I'm sorry, Larry. Go ahead.
No,
please.
Kim, if I could just add,
Sure.
It's why we like all the options on the table. And you really only have all the options on the table by having a good balanced approach. It's why I speak to the fact that we think you should have 50 to 100 grand as a benchmark in your mid 60s, retired or not even retired, in liquid monies. Tangible, easy access to cash. When the market's down, you need to draw. The grandkids have parties, the birthday parties, whatever. Again, options, and then stock market investments. The right type of efficient, diversified portfolio with all the asset classes that make up a good portfolio, and then an anchor to your retirement, maybe some investments that are principal protected, that don't have all the risks of the market, that if the markets are down, yeah, you might get a zero. You may give up some of the upside. You may give up some liquidity, but a good balanced approach gives you options when the economy and certain things they're changing, and we like options.
Yeah. Well, as I was going to say, Larry, this sort of circles us back to what this whole subject matter was all about, which was making good decisions in this lower rate environment. And if you aren't sure about those decisions, you're looking for a partner to help you make those decisions, give the folks at Haven Financial Group a call. It's 612-504-8400. That's 612-504-8400. We want to continue this conversation about lower interest rates. Coming up, we're going to talk about the cycle of lower interest rates, how that affects inflation, and then ultimately affects the economy. This is the Haven Financial Group Radio Show.